Picture this. You start doing what you always wanted to. You start investing. You know that's the right thing to do. Every month you save a little bit. $100 here, $200 there, and so on. You feel that you are in the right path and that you are responsible, disciplined, and financially mature. However, after some time you open your banking account and notice that you have $10,000 sitting there and it's earning around 0.5% interest. You do the math and find out that after an entire year, you will earn $50. But it shakes you because you keep watching video and hearing people talk about investing in stocks, index funds, and compound growth, and you start thinking, am I doing it wrong? Because saving money is important and you are right doing it, but saving along is not enough. And this is where many people get stuck and never progress and transition to investing. So in this video, we are going to break down the step-by-step path to turn saving into investing without feeling overwhelmed or risking you money. My name is Rafa, and if you want to develop financial and personally, take the chance to subscribe to channel to never miss a video. Let's start with something that might sound controversial. Saving money alone will almost never make you wealthy. This is important, but not the final goal. Saving money is the first stage, and in this stage, you want to protect your money. But what makes your money grow are the investments. Each one of them have a different job. To make things more clear, let's take a look at the math for a second. Let's take our first example and imagine you save $10,000 in a typical saving account earning 1% interest this time. After 1 year, you have $10,100. Not bad. Your money grew. But now, let's compare that with investing. Historically, the S&P 500 stock market has returned about 10% per year on average over long periods. You already see the difference, right? After 1 year, the same $10,000 would become $11,000. The difference might not seem that huge at first, but here's what most people don't realize. The real magic is not in the investing itself, but in the compound effect over time. After 20 years, savings at 1% equals about $12,200. Investing at 10% equals about $67,000. Same start in money, totally different outcome. And here is a secret. The biggest wealth gap isn't between people who save and people who spend. In fact, it is between people who save and people who invest. But here's the point. Many people never make that transition. It's a psychology reason, not math. Savings feels safe. Investing feels risky. When your money is on a saving account, it doesn't fluctuate. You can see it there, and you are secure that it won't drop 5% in a random Wednesday afternoon. On the other hand, investments move, sometimes up, sometimes down. And that unexpected moves scare people away. Now you might be thinking, I don't want to lose my savings. That's totally fair. That's their reason why this transition should be done in stages, not all at once. Let's walk through the step-by-step path. Step 1. Build a real emergency fund. Before you invest a single dollar, you should have 3 to 6 months of living expenses saved in cash. This money stays in savings and you should be able to have it quickly if needed. It's not for investing. It's not for opportunities. It's for unexpected problems like job loss, medical emergencies, car repairs. Because here's what most people don't realize. The biggest reason people panic sell investments is because they need the money too soon. An emergency fund protects your investments from your own life. Step 2. Separate mentally saving and investing. Think of them as 2 different buckets. Bucket 1, safety money. Bucket 2, growth money. Safety money doesn't move. Growth money is expected to move up and down to while working to make it grow over time. This mental separation reduces anxiety dramatically. Step 3, start small. Look, a lot of beginners think investing requires a lot of money, but that's not true. Many brokerage platforms allow you to start with less than $5. The goal isn't massive profits at first. The goal at this stage is to create the habit, because the habit is more important than timing. Step 4, focus on simple investments first. Here's where beginners often make a mistake. They hear people on social medias talking about crypto, day trading, and more complicated stuff, and the jump straight into them. But the simplest investments often outperform complicated ones. For examples, index funds. These funds track the overall stock market. Instead of trying to pick winning companies, you're investing in hundreds of companies at once. Lower risk, diversification, long-term growth, you're investing in all of them. It's simple and it works. In fact, the legendary investor Warren Buffett has recommended low-cost index funds for most investors. Now, the truth needs to be said. The most powerful investing strategy is actually pretty boring. That's what they call consistent investing. Let's look at this example. Imagine you invest $250 per month into the stock market. If your investments earn an average of 7% per year after 30 years, you'd have roughly $305,000. The interesting part is that you only contributed $90,000 yourself. The remaining $215,000 comes from investment growth. In other words, your money earned returns, and then those returns earned returns of their own. That's the power of compound interest in action. However, psychology still matters here because investing feels uncomfortable at first. Markets go down. News headlines exaggerate. People panic. And here is where discipline separates real investor from speculators or gambles. Let me give you a quick analogy. Saving money is like storing seeds in a jar. You're protecting them, but nothing grows. Investing is like planting those seeds in soil. At first, it looks messy. You don't see results immediately, but over time things grow, and eventually you have something far bigger than the original seeds. Now, you might be thinking, okay, but what if I start investing and the market crashes? This is a fair question, because throughout the history we had some marked crashes. But here is the key insight. Long-term investors take this as an opportunity and benefit from downturns because when the markets drop, your monthly investments buy more shares at lower prices, which usually leads to stronger returns when the markets recover. That's why experienced investors are not impacted to marked volatility and stay calm. They think in decades, not days. So let's summarize the step-by-step path. First, build a 3 to 6 month emergency fund. Second, separate your money into safety money and growth money. Third, start investing small amounts consistently. Fourth, focus on simple long-term investments like index funds. And fifth, stay disciplined and give compounding time to work. Because here's the truth most people eventually learn. Saving money gives you stability, but investing gives you freedom. The earlier you combine both, the more powerful your financial future becomes. If this video helped you understand the path from saving to investing, make sure to hit subscribe. And I'm curious about something. Are you currently in the saving stage? Or have you already started investing? Let me know in the comments.